There is a letter that lands on doormats across Britain every single week, and almost nobody talks about it. It arrives in a plain white envelope, Barclays, Nationwide, Halifax. There is no gold seal, no phone call, no handshake in a branch that probably closed down years ago. Just a short paragraph, a reference number, and one line that changes the entire shape of a person's life. Balance, 0. In 2026, that piece of paper is the most underrated wealth event in this country, because it is not really a financial milestone at all. It is the moment you quietly opt out of the loudest fear the British economy runs on, the fear that the roof over your head belongs to somebody else, and that every month you have to prove yourself all over again to keep it. From the moment that letter arrives, that conversation is finished, permanently. And what happens to you afterwards is not what most people expect. Let us start with the part that is pure arithmetic, because the arithmetic is genuinely extraordinary and hardly anyone runs it properly. The Bank of England base rate is sitting at 3.75%, and the average 2-year fixed mortgage in this country is now priced at around 5.5%. Anyone who has slipped onto a standard variable rate is looking at something closer to 7.1%. So let us use a clean, conservative benchmark, 5%. When you overpay your mortgage, you are not earning 5%, you are avoiding 5%, and avoided interest is invisible to HMRC. There is no tax return entry, there is no national insurance, there is nothing to declare, nothing to shelter, and nothing to lose. Now compare that with the alternative. You leave the money in a savings account instead. If you are a higher rate taxpayer, your personal savings allowance is £500 a year. That is it. Everything above that is taxed at 40%. So to genuinely match a 5% mortgage, that savings account would need to pay you 8.3% gross, before tax, guaranteed, with no risk of loss. There is no such product. It does not exist anywhere on the British high street. Even a basic rate taxpayer would need 6.25% to break even. That is the tax drag nobody factors in. And with the income tax thresholds frozen until 2031, more people are being pulled into that 40% band every single year without ever getting a pay rise in real terms. The overpayment is the only guaranteed, tax-free, 40% equivalent return available to an ordinary person in this country. Now here is the part the spreadsheets cannot show you. Picture a bucket. Every month, your salary pours in at the top. Wages, overtime, the side income, whatever you can generate. And down near the bottom of that bucket, there is a hole that has been drilled there for 25 years. The mortgage. It does not care whether you had a good month. It does not care whether the overtime came through or the work dried up. It leaks at exactly the same rate, every single month, on the same date, forever. Most people respond to that hole by pouring harder, longer hours, a second job, chasing the promotion, running uphill, faster and faster, purely to stand still. The moment that letter arrives, the hole is plugged. Nothing about your income changes, but suddenly every pound that lands in the bucket stays in the bucket. Same salary, same job, same commute, double the accumulation. It is the closest thing to a pay rise that does not involve asking anyone for permission. The rucksack works too. You have been walking up the same hill for 2 decades with a weight on your back, and because you put it on so gradually, you genuinely forgot it was there. Then one morning you take it off, and you realize you have been carrying it into every job interview, every argument, every sleepless 3 in the morning of your adult life. Which brings us to the thing that actually changes your behavior. The absolute flaw. Every household in Britain has a survival number, the amount you must generate each month simply to keep existing. For a typical family with a mortgage, that number might be £3,000. Housing, council tax, energy, food, the car, insurance. Take the mortgage out of it, and that number collapses to roughly £1,200, a drop of about 60%. Read that again, because it is not a budgeting point, it is a PowerPoint. Your employer is not paying you for your labour. Your employer is paying for your compliance with a £3,000 survival number. When that number falls through the floor, you stop negotiating from fear. You can turn down the toxic promotion. You can walk out of a job that is quietly damaging you. You can take the lower paid role you actually enjoy, or go self-employed, or say the thing in the meeting that everyone else is thinking. Nothing in your bank balance made you brave. The absence of a monthly debt entry did. And then there is resilience, which is where mortgage-free households become almost unrecognizable. Your car fails its MOT, not a small fail. Suspension, brakes, corrosion, the full £3,000 conversation. Or the surveyor finds structural damp creeping up the party wall of a Victorian terrace, and the quote comes back at £4,000. For a mortgaged household, that is a crisis. It becomes a credit card at 24%, or a loan, or a raid on the emergency fund that took 2 years to build. It ruins a Christmas. It causes an argument at 11 at night. For the mortgage-free household, it is an administrative task. £3,000 is roughly 2.5 months of a payment you no longer make. The damp gets treated. The car gets fixed. Nobody's heart rate changes. The event that would have derailed the old version of you is now, at worst, mildly annoying. Now let us talk about what happens if you are disciplined with the redirected flow, because this is where it stops being about safety and starts being about generational wealth. A couple finishes their mortgage in their late 40s. The payment that used to leave the account was £1,200 a month. They keep the direct debit alive. They simply change where it points, into a stocks and shares ISA, using the full £20,000 annual allowance, or into a SIP for the pension tax relief on top. Low-cost global index fund, 15 years, assume a 7% average annual return, which is broadly what global equities have delivered over long stretches. They will have contributed £216,000 of their own money. The pot will be worth just over £380,000. That is not a top-up. That is an entire retirement, grown from a payment they were already making and had already learned to live without. The house paid for itself, and then it planted a second money tree in the garden. Most people spend that money instead, and never see the tree that was available to them. But honestly, the money is not the part that people describe when you ask them. What they describe is any random morning, the start of the working week, alarm going off in the dark, kettle on, nothing remarkable happening at all. And underneath it, a background hum that used to be there and simply is not anymore. Because whatever happens next, to inflation, to the base rate, to the housing market, to the company you work for, to the global economy, nobody is coming for your front door. There is no institution with a claim on the room you are standing in. That is not a feeling you can buy. It can only be built. Which brings us to the awkward social part. Somewhere around year 3 of overpaying, you will notice that your neighbours are living better than you. There will be a new car on the drive next door, on personal contract purchase, £450 a month for 3 years, and at the end of it they will own precisely nothing. There will be the extension, the kitchen island, the holiday posted online in detail, and you will be doing something invisible. You will be upgrading your freedom, and freedom photographs terribly. This is the comparison trap, and it is where most overpayment plans quietly die. But understand what you are actually looking at. Visible wealth in Britain is almost always financed. Real wealth is quiet. It is the absence of an entry on a bank statement. It is the household in a modest semi in the home counties, with a car that is 9 years old, that owns everything it can see and answers to no one. You cannot see it from the pavement. That is the entire point. So here is where we land. The standard British script runs for 25 years, or 30, or 35 if you stretch the term to make the numbers work at a higher LTV. Pay the minimum, move up the ladder, borrow again, retire tired. Paying it off early is a manual override on that script. It is a decision to stop renting your own life back from an institution, 1 month at a time. And when it is done, the change is not the house. The house looks exactly the same as it did the day before. The change is the silence. True freedom in this country was never the size of the property. It is the silence of the debt. If you learned something, like and subscribe. See you in the next one.